After the special transactions, the cases of business transactions where special journal entries are passed, slightly critical, like advances, drawings from the bank for classification between personal and official purposes or the business purposes. After those transactions, we will take up the issue of GST being coupled with a business transaction. A brief introduction to GST, which is an indirect tax, the goods and services tax. India is working towards a harmonious, centralized, indirect taxation structure or policy. As an attempt towards that, we have 2 years for now implemented the GST across the country. Of course, divided into 4 parts, like the central GST, the state GST, the union territory GST, integrated goods and services tax, IGST, and the scheme for sharing of the revenue between the center and the states. Ultimately, GST, or the goods and services tax, is a tax on goods and services, as the name indicates. So when a purchase is made, when an expenditure is incurred, it is possible that a tax in the form of GST is levied and has to be accounted for. Now, India, or the Indian accounting system, is based on the exclusive method where GST paid, collected, remitted must be shown separately. For example, if a business purchases goods worth 1 lakh, and let us say the GST rate is 18%, central tax of 9% and state tax of 9%, then purchases and GST must be shown separately. And of course, it is the consolidated payment which goes to the creditor, including the GST element. So there are basically 4 types of GST. Let us exclude the UT GST, Union Territory Goods and Services Tax, to make it simple. There is a central goods, the GST therefore is in the 3 major parts: the CGST, or the Central Goods and Services Tax, State Goods and Services Tax, SGST, and Integrated Goods and Services Tax, IGST. You must understand which is applicable for which kind of a transaction. So normally for purchases, sales, expenditure, income, GST becomes applicable. When I purchase goods, when I sell goods, when I incur advertisement expenditure, I pay transportation charges, I pay utility bills, or I make a sales turnover. All of them are coupled with the appropriate or the applicable GST. Now, the fundamental policy is simple. IGST is applicable on interstate sale or purchase. So if, let us say, the IGST rate applicable on a particular consignment or goods is 18%, it is one single 18% which is levied. For example, there's a dealer or a trader in Mumbai. He is selling goods to a trader in Chennai. That becomes interstate. Whereas an interstate sale, the dealer in Mumbai will collect 18% IGST from the dealer in Chennai. So the IGST is a collection for the Mumbai dealer and a payment for the Chennai dealer. On the other hand, if the dealer in Mumbai is selling goods within Mumbai itself, then it is both these which are applicable, which means that CGST and SGST become applicable in a case where it is intra-state sale, purchase, expenditure, and so on. So going back to the same example where I had taken an example of a dealer in Mumbai selling to a dealer in Chennai, and I said the rate is 18%, it is one single unified 18%. So a purchase or sale of 1 lakh attracts GST of 18,000 as a receipt for one and a payment for the other dealer. Now suppose it is an intra-state, that is within the same state, sale or purchase, expenditure or income, and if the rate is 18%, that would mean that CGST is at the rate of 9% and SGST is at the rate of 9%. 9 plus 9, 18. So this 9% plus 9% would have been collected by the dealer who is selling and paid by the dealer who is purchasing. And remember, if it's a manufacturer, today's purchase is tomorrow's output. Today's purchase of input or raw material is for processing or manufacturing, resulting in a sale of finished goods. So we must understand that a consignment on which there is a purchase, on which GST is paid, is used for converting into finished goods and selling, or on a turnover in which GST is collected. So the business which is manufacturing pays GST on the purchase and collects GST on the sale, of course to be paid to the government. All the amounts collected are collected by the government through the business in India as an agent. So the business is only playing the role of an agent on behalf of the central or the state government. The collection of GST has to go to the government. In accounting, now looking at it from the accounting perspective, this was the legal angle. Look at it from the accounting perspective. When GST is paid on a purchase or expenditure, we call it input GST. That is, input CGST, input SGST, or input IGST. And when the GST is collected on a sale, what would happen? It becomes a credit entry. It is collected and it becomes output GST, output CGST, output SGST, output IGST, as the case may be. Now, at this stage where we are dealing with the primary accounting, we understand that the GST must be removed or shown separately from the purchase or expenditure or sales or income. So, looking at it from the accounting perspective completely, suppose there is a purchase transaction and suppose the amount is about 1 lakh involved, and let us say it is a intra-state purchase. How would the journal entry be passed? First of all, ruling out my journal, the credit amount in rupees, the debit amount in rupees, the ledger folio, the date and the particulars. This, if you remember, is the format of our journal for journalization or journalizing. Now let us say on the 1st of April 2020, there is a purchase of goods. The purchase is made from a dealer who is within the same state. Purchases account debtor 1 lakh. Now on the 1 lakh, the tax is 18%, split up as 19% CGST, 9% CGST and 9% SGST. So you would call it input tax CGST account debtor 9,000, input tax SGST account debtor 9,000. 2. cash, bank, creditors, whatever be the account. So to cash or bank or creditors, 1,18,000 being the purchase of goods attracting GST. So a reader of accounts seeing this will understand that this is a local purchase, not from a dealer outside the state. So here I have delinked purchases from CGST, SGST, IGST, whatever be the applicable GST. This is called the exclusive system. You have to separate them. The other method where this is not considered, but we don't follow it because we can't keep track of the taxes there, is called the inclusive system, where one single entry is passed without distinguishing the gross purchases and the GST. Purchases account debtor, 1,18,000. To sundry creditors account, 1,18,000. Now if there are hundreds of transactions like this during the accounting period, at the end of the accounting period, it becomes very difficult to identify the taxes paid, the taxes collected, the amount due to the government. So the ideal system of accounting when GST is involved is the exclusive system. Exclude it and show it separately. So this is a purchase transaction. The same could apply to any expenditure. For example, advertisement, interest, transportation charges. All the expenses which attract GST will have the same formula. Advertisement account debtor, 1 lakh. IGST or input IGST account, 18,000. To cash account, 1,18,000. So all the GST which has been paid by a dealer at the time of incurring an expenditure or purchasing goods or an asset for that matter would be debited. Now you need to understand the implication of this debit. Remember, every debit is either something that comes in, or it is an expenditure, or it is an asset. I'm just classifying my debits and credits in accounting language. Going back to our golden rules of accounting, in the case of a personal account, we debit the receiver, credit the giver. Those are for personal accounts. In the case of a real account, debit what comes in, credit what goes out. In the case of a nominal account, debit any expenditure or loss, credit any incomes, gains, profits. Now going by that logic, if input tax CGST is debited or input tax SGST is debited, what would that debit represent? Is it an expenditure, a loss, or an asset that comes in? And the answer is, it is an asset because of a concept called input tax credit. Similarly, suppose it is a sale transaction. Now, let us take up the case of a sale or an income transaction. I retain the format there. And then try to analyze how this GST is going to change, or how the treatment is going to change. How will the entry vary if it is a sale transaction? So the date, the particulars, the ledger folio, debit and credit. Accounting treatment when it is a sale. Let us say, using this input, on 1st of April 2020, we had made a purchase worth 1 lakh, on which CGST was 9,000, SGST was 9,000, and the total payment to the creditor was supposed to be 1,18,000. Using this input and manufacturing, let us say I sell within one week on the 7th of April 2020. This has been transformed into output and I am selling. So let us say I am effecting a sale worth 50,000, attracting an IGST. Let us make a change this time to IGST. It's an interstate sale. The purchase was intrastate, the sale is interstate. On the same rate, 18%, let us say. Now in this case, naturally GST has to be credited. It will be called output GST. So now what would be debited? Cash, bank, or debtors, account debtor. 2. Sales. 2. Output GST, IGST. You must also classify, not only show them separately. The sales, the GSTs themselves must be split between CGST, SGST and IGST. UTGST if it's a union territory. So, to sales would become 50,000. To GST, that is IGST, would become 9,000 at the rate of 18%. And cash, bank or debtors, 59,000. Being sales accounted subject to IGST at the rate of 18%. So this is the principle with respect to sales, where you have delineated and shown the GST separately. So this cycle continues. This accounting keeps going on. Let us say there are about 220 purchase transactions during the year 2020-21 and about 340 sales transactions during the year 2020-2021. At the end of the year, preferably it must be done at the end of every month, a reconciliation. The total GST collected, the total GST paid. Or actually the other way around. A purchase becomes a sale later. So total GST paid and the total GST collected, classified into the 3 or the 4. CGST, SGST, IGST and UTGST. And this has to be matched to see what is the differential amount due to the central government or the state government, as the case may be. IGST is payable to central government. CGST is payable to central government. SGST is payable to state government. UTGST is payable to union territory. So in other words, every expenditure or income which is attached to GST or to which or on which GST is applicable must be accounted by the exclusive system. So the expenditure or income is accounted without the GST element, and GST is shown separately. In fact, this is exactly what we call a compound journal entry. Let me take this opportunity to introduce the principle of or the concept of a compound journal entry also, where you have a single debit and multiple credits, or multiple debits and a single credit, or multiple debits, multiple credits. So one journal entry or one transaction, one business transaction could have 2 or more components, at least 2 legs. One which is debited and the other or the others which are credited. So you can apply the same thing, for example, with respect to if this is interest income. rental income, brokerage income, commission income. In the case of any income, the income is credited by itself and the GST is disclosed separately. What we will be seeing next in our accounting sessions is the ledger, where the transactions go from the journal. Onward accounting. We are still at the primary stage of identifying the two limbs of a transaction and debiting one and crediting the other. So at the end of a month, after all the business transactions of the month of, let us say, April have been journalized, the next stage is to post into ledger, which we'll be seeing next. So when all these entries have been passed and ledger accounts have been prepared, at the end of a month, one figure is thrown up, which is the consolidated figure for that particular month. For example, all the transactions involving sales and accompanied by IGST would have this entry: cash or bank or the debtors account debtor to sales to output IGST. And all purchases which are, let us say, made within the state, purchases account debtor, CGST input tax account debtor, SGST input tax account debtor to cash or bank or debtors, depending on whether cash is received, a check is received, or debtors have to pay it later, creditors have to pay, we have to pay the creditors later. So at the end of the month or a particular period, let's just say 1 week, 10 days, 15 days, 20 days, 30 days, a month, we get the aggregated sum. So at the end of April, on April 30th, in the evening at 5:30 p.m., April 30th, 2020, I will be able to judge what is my total sales for the month, what is my total purchases for the month, what is my total advertisement expenditure for the month, rental income for the month. Every ledger account finally ties up that aggregate sum for the year. So going by that principle, remember at the end of a month, even these tax accounts throw up one single figure, and that has to be matched. So input tax GST, input tax GST CGST account, input tax SGST, input tax IGST. They have to be matched with the output tax CGST, output tax SGST, and output tax IGST. So these are transactions which are booked to ensure that no transaction escapes accounting. That is ensured by the journal. The next stage of accounting, that is ledger, will decide the single figure, the aggregate for the accounting period. The aggregate or total sales, the aggregate or total purchases, and at the end of the month, they will have to be matched up. Let us say, I take an example. Let us fast forward life to, let us say, today is April 30th, at the end of which you get consolidated figures for all these transactions. And let us say, after having posted the transactions into ledger, I have an input tax CGST, input tax SGST, input tax IGST, and I have an output tax CGST, output tax SGST, and output tax IGST. Let's take certain figures. Let us say this comes to about 1,08,000. This comes to about 90,000. 90,000. This is about 54,000. 45,000 dollars. They are usually equal, so I'll make it 45,000, 45,000, and let us say the IGST is 90,000. So this is the position at the end. So this has to be matched up. So you will match up CGST with CGST, SGST with SGST, and IGST with IGST. So this is the GST impact of accounting. So let's wind up with that for this session. We'll continue in our next session.